Have you ever wondered, how much money would it take for you to completely retire from your job and live comfortably for the rest of your life? Unfortunately, the answer isn't that simple. Finances are like fingerprints. They're unique to everyone. The amount of savings necessary to retire will differ from person to person. Sadly, most people can't even think about retirement. That's because they don't have a financial plan in place, let alone a retirement strategy. The assumption has always been that you retire around the ages of 62 to 65. However, retirement isn't about your age. It's more about a financial number. In other words, having enough money saved to maintain your desired standard of living, long after you stopped working. In this video, we will take a look at 7 key factors you should consider when determining your actual retirement age. But before we begin, please hit the like button and subscribe to the channel. Now, let's get you retired. The first factor you should consider when determining your retirement age is cost of living. Cost of living isn't driven by where you're currently residing. It's more based upon where you see yourself living when you retire. They can be vastly different. Certain cities like San Francisco or Manhattan will have much higher cost of living requirements than other US cities. In addition to housing, you must include the cost of transportation, food, taxes, and healthcare expenses when calculating the total living costs. Most people who are contemplating retirement favor living in areas that are close to family and friends. It's not so much about the destination. It's more about community. The second factor you should consider when determining your retirement age is inflation. What exactly is inflation? Inflation is defined by the gradual rise of your overall cost of living over time. Today, inflation stands around 3%. This may not sound like much, but over the course of 20 to 30 years, it can have a major impact on your overall savings. For example, if you currently have a monthly spending rate of $2,500, in 30 years, you will need to have at least $5,800 in monthly savings, just to have the same purchasing capability. The best way to offset inflation and make your money grow is to invest it wisely. Long-term investing will help multiply your savings faster than if you had it stuck in a bank. The third factor you should consider to determine your retirement age is the cost of health care. For most people, this will probably be the most expensive aspect of calculating their age of retirement. Healthcare costs continue to rise and are something you should be prepared for. One option you should consider to offset future healthcare costs include opening a health savings account or HSA as soon as you can. HSAs are simple to open and offer many tax advantages. A couple of other options you can investigate as you get older include applying for Medicare and purchasing a long-term care insurance plan when you reach 60 years of age. Because receiving continued quality health care is very important, researching the best options for you should be a top priority, even though it may be difficult to estimate long-term healthcare costs. Having a solid plan in place today is critical to having the resources available to receive the best possible care for the rest of your life. The fourth factor you should consider when determining your retirement age is your desired standard of living. Think about it. How do you see yourself living in the future? Do you want a relaxed lifestyle? Do you want to be more active? Do you want to downsize your home? Or would you rather live in another type of climate? Whatever lifestyle choices you make, your savings plan will have to be adjusted accordingly. Some standard of living considerations include how often do you plan to travel, dine out, or how much you want to assist family members with things like college expenses. Always keep in mind that your lifestyle choices and any family obligations have a direct impact on your retirement age. The fifth factor you should consider when determining your retirement age is using the 4% rule. But what exactly is the 4% rule? This rule is based on a Trinity University study that concluded you could safely withdraw 4% annually from your savings without the fear of running out of money. Do you know how much savings is needed? In 2020, if you're like the average American, you need just over $1.4 million. Having this amount in investment savings, following the 4% rule, you should be able to safely withdraw $57,000 every year, without ever impacting the principal or initial investment. In other words, you can live off the interest or earnings of the $1.4 million. Assuming your retirement lifestyle expenses don't exceed $57,000 a year. So what do you think your savings number would be? A good way to estimate how much investment savings you'll need in order to retire is take your total annual expenses and multiply that by the number of retirement years. Studies have shown that the average retirement lifespan is approximately 25 years. Therefore, take your total annual living expenses and multiply that number by 25. As an example, if your annual expenses are $70,000, when multiplying that by 25, it results in $1.75 million of savings needed to sustain the 4% rule. If your annual expenses are only $30,000, when multiplied by 25, it results in $750,000 of savings needed. Depending on what your retirement lifestyle is like and how long it will be. When using this simple calculation, you can easily estimate the savings needed for a comfortable retirement. The sixth factor you should consider when determining your retirement age is Social Security benefits. Typically, these benefits are available at the age of 62. However, did you know that if you wait until 70 years old to claim them, your benefits are much more? It's to your advantage if you can wait as long as possible. The tricky part about Social Security is its longevity. Currently, Social Security, which was enacted in 1983, is only stable until 2037. Unless additional changes are made. With this in mind, as you consider your retirement age, it's best to view Social Security as a bonus rather than a necessity. The last factor you should consider when determining your retirement age is how to save for it. The best options for retirement savings are company-matched 401ks, Roth IRAs, or personal investing with stocks or mutual funds. Each option provides successful long-term retirement savings. 401ks are accounts offered to you by your employer. With each pay period, a portion of your pre-tax paycheck goes into a retirement account. Your employer might even match your contribution up to a certain percentage. Roth IRAs place after-tax dollars into stocks, bonds, or index funds. And, when you're able to withdraw from them, you pay no taxes. Keep in mind that 401ks and Roth IRAs don't allow penalty-free withdrawals until the age of 59.5. The third option of personal investing allows you more control of where and how often you save. It also gives you the ability to withdraw at any time. The more options you take advantage of, the more your savings will grow. So, what's your retirement number? How much money will you need? What will your retirement lifestyle be like? Hopefully after today's video, you have a better understanding of how to determine your retirement age and what it takes to make it happen. You don't have to wait until you're 62 years old. It's possible to retire at any age, as long as the money you've saved is enough to sustain your desired lifestyle. If early retirement is what you hope for, then aggressively saving now is the most important thing you can do. Having the luxury to do what you want later in life is completely dependent upon the actions you put in place today. Thanks for watching. If you liked today's video, please click the like button and subscribe to the channel. Feel free to leave a comment below. For more financial tips and strategies, check out the next video by clicking the link on screen.